Ever hear of a bridge loan?
No.
This is one of the fastest and riskiest loans in banking. A bridge loan is a short-term loan used to bridge the gap between two financial situations. It's commonly used in real estate when someone wants to buy a new property before selling their current one. For example, you find a new house, but your old house hasn't sold yet. The bank gives you a bridge loan to cover the down payment or purchase. Then when your old house sells, you pay off the bridge loan. Sounds convenient, but here's the danger. Bridge loans usually have higher interest rates than normal loans. Short repayment timelines, often 3 to 12 months, and sometimes double payments if your old property doesn't sell fast. If the sale delays, you can end up servicing two loans at once, and that's where people get into serious financial strain. Bridge loans are powerful for timing, but dangerous for cash flow. They should only be used when the exit plan is solid and guaranteed.